Hello, my name is Yoni,
And my name is Andreas.
and this is our case competition on Altice USA.
Here's a table of contents for reference. On the company overview, Atlas USA is a broadband communication services company. It operates through three brands, Optimum, News 12, and Optimum Media. It's a very CapEx heavy model because it relies on fiber and communications. They've continued to build out fiber. It's been a major growth lever for them. And they are continuing to invest in their mobile line and broadband division as well. They see diversified revenue streams from both their mobile and also their news services divisions, which they are expanding as well. And they've pushed into non-traditional revenue streams such as news and advertising, which they weren't previously in before.
Yeah, so just to expand on that a little bit, a lot of their struggles right now come from expanding their fiber optic network, which means that they haven't fully captured their fixed cost absorptions, which is why they're facing a liquidity crunch right now. Yeah, so building on that a little bit, on their specific situation. First of all, there's a few strategic risks, one of them being competition from entities with smaller regulatory burdens. So any entity that's facing less regulation will obviously be able to have higher margins and kind of cut corners a little bit. Meanwhile, Altice is suffering from having really strict regulations set on them. In addition, other things like technological disruptions is really common for the field, and it's causing them a lot of struggle, both the industry in general, specifically Altice. Although arguably the largest thing that they're facing right now is heavy indebtedness and their upcoming maturity wall. So currently enterprise value consists of 99.82 consolidated debt, showing that equity is almost completely wiped out, if not worthless at this point, or purely trading off optionality. And we can see that Altice was at negative net free cash flow in quarter one of 2025 compared to positive cash flow in quarter one of 2024. But we project the business to continue being cash flow positive going forward. So it's more so a matter of the maturities than the actual cash flow.
As you can see, there's a capital structure overview. They have a few revolving credit facilities that have fallen significantly in market price. They face upcoming debt maturity walls of $697.2 million dollars, and they also entered into a revolving credit agreement with a subsidiary, Lightpath. As for the business plan, we see possibilities of expansion through the continued capital expenditures spending to get ahead of competition. We also think that resolving current leverage and avoiding the maturity walls is key to the business success, which is our recommendation. And we are seeing Atlas continue to expand their non-traditional revenue streams, such as the news and advertising segments, and pouring lots of capital into that area.
Yeah, so moving on to valuations, here we have the basic football field analysis where we see an average EV of $21 billion, falling just a little bit short of the actual market EV, which is at $26 billion. From this, we see that the DCFs yield pretty pretty conservative EV values. Meanwhile, the PTA has the largest range, which makes sense as the present transactions in this industry have been quite varied across the years, followed by comps also being quite varied, but very much based in where the actual EV ends up being. And then the analyst target is just an expected value coming from like 52-week high lows. Then on the discounted cash flow, it follows the normal model for discounted cash flow with unlevered free cash flow in the top right. That's specifically the 2030 bridge, but the entire unlevered free cash flow is shown in the appendix. Then moving to the bottom left with WACC calculation shows all the components of WACC, and we chose a range of +2 on WACC, so two above, two below, each varying by 1%. And that can be seen in the sensitivity tables on the bottom right. So we see that the Gordon growth method is significantly discounted just because the fact that Gordon growth with such a high WACC will discount the future cash flows a lot. Yeah, so moving on to present transactions, as I said earlier, it has the largest range. Specifically, deals from like 2016 to 2020 have very large ranges, and we see that with Northwest Fiber's deal significantly dragging the multiples up. Same goes for comparable companies. Frontier Communications significantly pulls the average up, but with our 75th percentile average and 25th percentile, we see that EV to EBITDA is quite a stable ratio, matching almost exactly the market EV.
As for liquidation analysis, assuming low percent recovery, we estimate that the total value will still be much lower than current enterprise value. Even in a high sensitivity case, we produce recoveries of 8.3 billion, which is still very short of Atlas's debt stack. The recovery waterfall, everyone would receive full recovery except for the CSC holding company senior secured notes, who would only receive a 22, or senior notes, only a 22.51% recovery and no remaining value for equity holders.
Yeah, that just had to do with structural subordination. Then for our preliminary recommendation, we're both weekly readers of Pari Passu, and we thought that this would be the perfect time to actually transact one of the recent transactions that we've read about, which was the E&E transaction done by Better Health. We spread through the credit docs and the lenient language allowed for this to happen. Then after looking at creditor groups, we saw that creditor groups right now have an agreement, um, uh, a non-creditor on creditor violence agreement that's terminating at the end of this year. So early 2026 would be the best time where we could split up creditor groups and really get some creditors involved in the transaction. In addition to that, the class language and both the Pari new debt covenant both allow for senior priming debt once you do the E&E transaction. We would use Oregon Tools and Better Health as textbooks for this, and we can see that injecting around $2 billion of new liquidity would provide significant upside for the company, as well as allowing us to trade debt for around 85 cents on the dollar, which would significantly reduce debt. If you want to speak a little bit more to that.
As to reducing overall debt, we would see that total consolidated debt of 25.5 billion, which is the current situation, would change due to participation, expected to be 60.65%. That would inject 2.5 to 3 billion new money of secured debt, which would rank higher, thus the CERTA aspect of the recommendation.